This video covers Chapter 6 material on common stock valuation. Specifically, I'm going to cover the dividend discount model applied to Starbucks. Everybody knows about Starbucks, the coffee company. I'm going to get my data from finance.yahoo.com, and I plan to look at the constant growth model, the two-stage growth model, and the three-stage growth model, and I'll go through the trials and errors of trying to value a stock using the dividend discount model. You know, I make it look easy on the internet. I make it look easy on the blackboard when it's, you know, when you're just hypothetically valuing businesses and valuing companies. But when it comes to real data, it's a slightly different story. So let me start going through this, and I'll show you what I mean by some of the complications, and you'll see it arising pretty quickly. Now, before I go any further, let me tell you where I got my information. It came from finance.yahoo. Normally, what I do is I have this thing called Snagit. It's a software that snags a snapshot of screenshot of my screen and whatever I have, and I can use that in the videos, but the print is so small in finance.yahoo that you won't be able to see it. And even, you know, I've even printed it off in a hard copy to show you. The print is very, very small. But if you go to finance.yahoo and you type in the ticker symbol SBUX, you'll find a ton of data on nearly any publicly traded company. And I'm going to be using some of that data to value the stock using the dividend discount model. For example, here the beta, you probably can't read that, it's 0.78 is the beta. 0.78 is the beta. It's dividend, the forward dividend here, that's 80 cents a share forward dividend. It's telling me the payout ratio is about 42%. Okay. If you go to other parts of the website here, it'll tell you the growth rate in earnings for the past 5 years, and then projected 5 years as analysts project, the growth rate. Here the growth rate is projected to be about 18% or a little more for the next 5 years. That's the average from what analysts are tracking. I came up with a different number. This number of 18 is an average. There's people well above it and people well below it, and probably most of them around the 18 mark. I come up with, I believe, 24%, and I'll show you how I calculated that. So let's just jump right in. Let's do constant growth model, which is basically one stage. So we're doing, think of it G, growth rate, time, one stage. Remember, I told you it's about the most unrealistic of the models, but it's the first model you want to teach when you do the dividend discount model because it's the simplest, and you get the intuition that you need. But when it comes to actually applying it, it becomes quite difficult because most stocks have growth rates that are higher than the discount rate, and that's the rub with this model. Let's look at what I'm talking about here. You have, according to finance.yahoo, the dividend next period D1 is 80 cents, and that's a forward-looking dividend. And so, why do we need that? We need that because I'm going to use this estimate right here. I'm going to estimate the stock price using D1 divided by K minus G, and I'm telling you this D1 is 80 cents, the top part. Now let's look at K. K equals the risk-free rate plus beta times the expected return on the market minus the risk-free rate. The opportunity cost of money through the risk-free rate, and then beta, which measures the systemic risk. How much risk does this firm have? We know that the risk-free rate is ballpark about 0.25%. That's the interest rate on 3-month Treasury bills, and you can find that in the wallstreetjournal.com, cnbc.com, or treasury.gov. And then, so that's the interest rate. It's 0.25%. The beta for this stock is 0.78. So Finance.Yahoo says the beta is 0.78. That's telling you, look, this stock has about 22% less risk than the average stock. Because the average stock has a beta of 1. This is a 78% of that. In other words, 78% less risk. Now you got to ask yourself, does that make a sense? Well, it seems a little low to me. I mean, I understand that it's in a stable business, and we're valuing Starbucks. It's a relatively straightforward, I would, compared to other stocks, is relatively straightforward to value because it's in the coffee business, and that's mainly its business. And you know, whether it's retail, it's coffee from coffee shops or packaged coffee, it's all in the one area of the economy. And so, you know, you can say, well, it's in the food space, and so it should be low. Yes, but it's also, you know, a specialty brand that can be a little more unstable than others because, you know, you got to have, you got to pay a reasonably good price for this coffee, and if you go into economic downturns, you know, your sales could fall off quickly. So, you know, if the economy drops, and the stock may drop significantly. So you're looking at that beta because beta is measuring the systematic risk. So 78, you know, it's a little low. Maybe it could be close to 1 to the average, but we'll live with it. You could calculate your own beta, but this beta is 0.78, is looking at, you know, over the past couple of years, how has the stock behaved relative to the market? It's behaving with a 0.78 beta, meaning slightly less risky than the market. Now, the expected return on the market, I'm going to use 10%. I've been telling you, look, past 80 years, it's been 10 to 12%. So what do you expect to happen over the next year? Well, my best guess is 10%. You could use 10, 12, anything you think is reasonable. Now, the risk-free rate is, again, 0.25. And so we do this calculation. We come up with 785, or about 7.9%. That's what I'm going to round it to. So that's K. Now let's do G. Okay. So now before we leave K, ask yourselves now, is 8% a decent amount of return for Starbucks over the next year, say? Is that a decent enough return? Remember, this is your required rate of return given the risk of the stock. And so here's the measure of the risk. And that's what we require. You know that comes from capital gains and dividend yield. All adds up to just under 8%. So that feels okay. It could be a little shade low, and it could be because of this 0.78 beta. You know, I kind of feel like I want to raise it up a little bit, but I'm going to stick with the data. And remember, I told you this is an art and a science, and I'm going through the calculations, showing you the science end of it, and I'm talking a little bit about the art end of it. The artist in me, which is not much, the artist in me would say, these are just a little low, and you might want to boost that up. But what it's saying is still in the ballpark, 8%, given the risk of Starbucks. Okay, we'll live with it. Now G, couple of things you can do with G. If you look at the 5-year analysts' growth, analysts estimate a little over 18% growth for Starbucks. But that's basically a normal distribution, around 18%. Because you've got to have some analysts that are well above, some analysts well below, and hopefully a number of them are ballparkish 18. Okay? That's over the next 5 years, according to analysts. And analysts do not have a good track record. Because they have fuzzy crystal balls like everybody else, basically. Their crystal ball is not clear. They can't really see the future. And there's been lots of studies on this. So their outlook is fuzzy. So we could use the 18%, but what I'm going to do is let's experiment here and use the sustainable growth model that I showed you. Growth is equal to the return on equity times the retention, 1 minus the payout ratio being retention. This is net income divided by equity, and payout is dividends per share divided by earnings per share. So you can look up ROE right from finance.yahoo, or you could recompute it using Yahoo numbers. And when I recomputed the ROE for Starbucks, I computed it for the past year and the year before. And in both cases, it came out to around 40%, low 40s. And so I'm going to use an ROE of 41%. 41%. And which is, by the way, that's quite high. But that's what it's done over the past couple of years. And so you want sustainable numbers here. You don't want to, by the way. So I looked over the past couple of years to make sure that that was sustainable. So what you don't want to do is hook on to a time period where you have a big spike in earnings or a big drop in earnings and try to use that to extrapolate into the future. You want to find ROE and you want to deal with numbers that you think are representative of long-term potential for the firm going out into the future. So 41% is reasonable given that it has done so in the past for a couple of years. Okay, so payout ratio. The payout ratio is 80 cents divided by $1.63 in earnings. That's approximately the numbers what I used. I looked and I went to finance.yahoo. Finance.yahoo said, look, if you look carefully at it, it's about 42% payout historically. This is just a point. This is just one particular year, but historically around a 42% payout. So it's close. I mean, this is about 50%, a little less than 50%. This is telling you 42. I'm going to go with the 42. When I get all said and done, my estimated growth is 24%. Whew. That thing is growing at 24% per year. So as soon as you plug this, don't even try plugging it into this model, because you see that K is greater, K is only just about 8% and growth is 24%. So it's never going to work. So you got to ask yourself, what is going on here? Why does the model break down? And you know why the model breaks down. You know that, look, this stock, the dividend, this 80-cent dividend is growing at 24% per year. That's what we're assuming, forever growing 28% per year in this model, one-stage growth. We're discounting things back. So this is really, by the way, this is snowballing. It's like a snowball getting bigger and bigger and bigger. It's getting bigger at 24%. When you discount things back to get a present value, well, you're discounting it back at just under 8%, 7.9%. So really, you got this thing growing at 24. It's shrinking at 8. It's really the net growth in this cash flow is 16%. It's growing at 16% forever, which means the estimate of the stock price is really positive infinity. It's not negative, which is what you would, mathematically, this is what you would think here. Plugging in 8% minus 24. It looks negative. That's just the fact that the math consolidates down. You lose something in the consolidation of the math, even though it's theoretically sound if you can stomach constant growth forever. Okay, so what I just showed you was, this is the first thing you should do when you look at a stock, and that pays the dividend, by the way, pays the dividend. You want to check it and bounce it against this constant growth model, because it takes a few minutes to do. It's the quickest and dirtiest. Now, given that I failed here, and we failed, which is nearly the case, because nearly all stocks have growth rates that are fairly high. And where does that growth come from? That growth, Starbucks is growing not only internally, but it'll do acquisitions. And so when it acquires companies, it grows not just from internal, but if it buys businesses that are in the coffee packaging area, or they grows coffee or whatever, or roasts coffee, which is what Starbucks does, then that growth can come about for a number of years. And lots of companies in the Standard & Poor's 500 index, they do their growth long term by doing acquisitions, in part acquisitions. Okay, now let's do two-stage growth. Two-stage. In fact, I'm going to get a new piece of paper here. There's going to be a number of calculations done. Now, first thing you want to do, two-stage growth, do a timeline. So here's the timeline. So here's the timeline set up. 4, 5, 6. I'm going to go all the way out. Now, let's draw a graph of what's going to happen. Two-stage growth says, look, it's going to grow at a really high rate for a period of time, and then it's going to drop down to a long-run sustainable growth rate forever. I'm going to stick with the 24% growth rate for my first stage growth. And I picked 5 years of 24% growth. Not forever, but only 5 years. That's convention. It's common to make that assumption, so I'm going to stick with the assumption. Then I'm going to assume it drops down to a 5% growth rate forever after that. And that 5% can include, 2% inflation. So if it includes 2% inflation, 3% growth forever is plausible, real growth. So I'm making a number of assumptions here. I'm saying 24% for 5 years, 5% from 5 years after, forever. And now I need to grow my dividend, which is anchored here at 80 cents according to finance.yahoo. I need to grow this by 24. And I do that, and this comes out to be about 99 cents. Grow it again by 24, $1.23. Grow it again by 24%, $1.52. Grow it again, $1.89. And then look, 1, 2, 3, 4, 5. The 6th year, it's going to grow at 6% or 5%. This dividend is going to be, the dividend right here in year 6 is going to be $1.99. So look, I just mapped out all my cash flows, which is really important because remember, the value of any asset is the present value of its future cash flows. I mapped out all the future cash flows. Well, almost. I mean, obviously this goes out to infinity, but I'll show you how to deal with that in a second. And now all I got to do is discount everything back. Now, let's get rid of this cash flow all the way out to into infinity, because it's going to take me, I'll never be able to calculate those cash flows and discount them back. So what I'm going to do is assume a constant growth starting in year 5 at 5%. So, oops, this is D6. So look, this is the price, an estimate of the stock price in year 5 is equal to the dividend in year 6, here, divided by K minus G, a constant growth of 5% forever. So when I do that, this is $1.99 right here, divided by, I'm going to use that 7.9% K that we calculated earlier, and my 5% growth assumption. This comes out to be $68.48. But that's year $5. Let's get it into today's dollars. So I'm going to take this 68 and I'm going to divide it by 1.079 to the 5th power. I'm going to discount it 1, 2, 3, 4, 5 periods. It comes out to be today $46.92. So the value of all the cash flows out to infinity starting in year 5, well, actually the dividends starting in year 6, going all the way out to infinity. Today it's worth about $47. Now, I want to take this dividend and I need to calculate the present value of it. Right, this $1.89. So $1.89 divided by 1.079 to the 5th power. 1, 2, 3, 4, 5. That comes out to be $1.29. I need to calculate this dividend. So what I'm doing is I'm calculating the present value of all these intervening dividends. Because you get these dividends, you get this, so I need to figure out what they're worth today. So here I'm going to take $1.52 divided by 1.079 to the fourth power. And that's worth $1.12. And I'm going to discount this guy back at nearly 8%. That's worth 98 cents. This is worth 85 cents. And this is worth 74 cents. So I add these numbers up, all these present values, and I get 51.90. Wow, okay. That's an estimate, so put a big hat on it, of the stock price today. The actual stock price is about $58.50. Okay? Now, if you believe in all my assumptions that I did here and all my calculations, well, the calculations are all right. I checked them on a spreadsheet. I have a spreadsheet that'll do this pretty quickly. You just got to throw in the assumptions and it calculates it all out fast. You know, can you stomach 24% for 5 years and then dropping down to 5% forever? You know, is 5 years good? Is 24 good? Is 5% good? Those are important questions. If you agree with all those assumptions and you think you're really good at doing this, then I've just shown that this stock is overvalued by about $6 or $7. It's overvalued by. You wouldn't want to buy this stock. You might want to short it, or you might want to question. In reality, you'd question whether or not you had the right assumptions, because you're pretty close. I mean, we're not super far apart. So it could easily be there's different assumptions. The stock market, the average investor, maybe he's thinking growth rate's a little higher for maybe a little bit longer. So that's two-stage growth. It's not as realistic as we would like because, look, constant growth and a sudden sharp drop, that's not likely to happen to Starbucks, right? Companies generally don't drop off that fast in terms of growth. They usually come down in a slow transition period. Hence, three-stage growth. Let's do the three-stage growth model. Now, as you saw in the two-stage growth model, there was a lot of calculations. And I'm not about to go through all the calculations. I'd be here for an hour trying to do all those calculations. I'm going to tell you what I did. And I confirmed it all in the spreadsheet. So what I did was I assumed growth of 24% for 5 years, just like I said earlier, two-stage. I assumed a transition period of 5 years down to 5% growth. So basically I'm losing about 1.7% growth per year in year 6, 7, 8, all the way down to year 10. Okay? So that's my growth. First stage, second stage, which is the transition, 3 is long run growth. Okay? And when I estimate that, so I grow that 80 cents, I grow it for 24%, and then I grow it at, nearly 22% and, 20% and so on. When I do that, I come up with a stock price of about $57, estimate of the stock price, versus actual, again, of $58.50 actual. So that's pretty close. That's reasonably close, $1.50. Remember, I did a lot of rounding, and so when you put all this in a spreadsheet, the rounding problems disappear, but you have rounding issues, and I have some rounding issues. You have to be very careful, because when you start going out to infinity and you're modeling things that go out to infinity, if you've got a rounding problem, that little rounding problem is growing out at infinity at 5%. It could have an implication to the value of your stock, obviously. So be careful. So that's why Excel spreadsheets are great for this type of modeling, and that's what I did. Now, the way to interpret this is, look, again, it's my model says the stock's a little bit overvalued, if you can agree with my assumptions here. But the point of this is sometimes you want to back into it from a different direction and look at this valuation. So here's how you might want to think about this. Can you, or do you agree with these growth estimates? Are these too high or too low? because that's what's built into this stock price. This stock price basically has this built into it. Since these two numbers are so close, this $58 has pretty darn close these assumptions of growth. Can you stomach this growth? Do you think that that's going to happen? If you think that growth is too low, then the stock's probably a good buy, these growth estimates. If you think my growth estimates here are too high, then you want to sell the stock, or you don't want to buy it at all because it's overvalued. So these are the trials and errors of trying to value a stock using the dividend discount model. First stage, back of the envelope calculations, rarely will work, but it's a good place to start. Go to stage 2, a little bit better. Stage 3, much better, and you can kind of see what's built into the stock price at this point and ask yourself, does this make sense?